US consumer confidence lifts ahead of stronger GDP figures expected today, although weaker US jobs data overnight shows signs of a cooling labour market. And Australian consumer confidence is strong ahead of data today expected to show headline inflation in Australia fall to within the RBA's target band. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Head of FX Research Mahjabeen Zaman analyses the potential impact of today's inflation numbers on the Aussie dollar.
The pressure on the Aussie will be much larger on the downside if we do get that weaker than consensus print rather than a stronger print.
But first, in 5 and 5 with ANZ, US economic data was mixed overnight, ahead of key growth and jobs figures later on this week. At 4 a.m. Sydney-Melbourne time, the S&P 500 was up 0.2%, and the yields on US Treasuries up 1 to 4 basis points. Overnight, US consumer confidence rose at its fastest pace since early 2021, while job vacancies fell by more than expected, indicating a cooling in the labour market. ANZ economist Bansi Madhavani says there was still one available job per unemployed person, meaning the labour market isn't rolling over just yet.
Put together, the surge in consumer confidence and the softish JOLTS data supports our view that yes, the US economy is headed towards a soft landing scenario. We will get a more holistic read of the state of the economy this week, with third quarter advanced GDP data out later today and the non-farm payroll.
The US dollar was up 0.15% at 4 a.m. Sydney-Melbourne time. The Aussie was down 0.45% at 65.53 US cents, while the Kiwi was down 0.33% at 59.60 US cents. Number 2. Bansi says markets are currently pricing in a 25 basis point cut by the US Federal Reserve in November, although traders are still questioning whether another one will be on the cards in December. We'll get a better read on the state of the US economy this week, with third quarter GDP data tonight and then non-farm payrolls on Friday. ANZ international economist Tom Kenny is expecting annualised growth in excess of 3% in GDP.
This is well above potential or trend growth, which is slightly under 2%. Based on healthy retail data, household consumption is expected to contribute around 2 percentage points to this 3% growth.
Number 3. Australian consumer confidence has risen in recent weeks to a 20-month high. The ANZ Roy Morgan survey shows ANZ Australia economist Maddie Dunk notes an improvement recently for renters in particular.
The good news for renters is that we do look to have passed the peak in annual rent growth, and in some places we've seen that it's moderated quite sharply. And then on top of that, there's of course these cost of living relief. So I think that's really supporting confidence amongst renters, and we're seeing that on a 4-week moving average basis. Confidence amongst renters is at its highest level since March 2023. Now, for other cohorts, what we've seen is that for those people who own their home outright, they've consistently been the most confident group, and that makes sense. They haven't had those challenges associated with rates going up quite significantly. And in many cases, if they've got strong savings, they've actually benefited from higher rates. And then for people who are paying off a mortgage, what we've seen is that, yes, confidence improved, but it's improved the least of the 3 cohorts over the last couple of months. And I think that goes to the point that the RBA has been a lot more hawkish than other central banks globally.
Number 4. Maddie says a recent improvement in overall consumer confidence has yet to translate into a real increase in attitudes about buying a major household item. Maddie says there's a few possibilities.
One is that people are holding out for those sales events at the end of the year. We know things like Black Friday, for example, are becoming increasingly important on the retail calendar. So perhaps people are waiting for those sales events before they go out and start spending a bit more money. But it's also likely reflective of the fact that times are tough for people. We know that confidence has improved, but a lot of people are just using that extra money to pay for the essentials rather than pay for fun, big ticket items.
Number 5. In Australia today, the market expects headline annual inflation of 3% in Q3. That's at the top of the RBA's target band. ANZ Group Chief Economist Richard Yetzinger is forecasting annual trimmed mean inflation of 3.5%, with quarterly growth of 0.8%. Richard says a trimmed mean print at or below 0.6% in the quarter, could make a rate cut possible this year.
Our expectation is the headline CPI will be within the target band, but core CPI will not be. And in fact, even on a kind of 6-month annualised basis, core will still be above the target band. The risks are reasonably balanced, but certainly a downside surprise would throw some decision uncertainty into the market about to what extent then the Reserve Bank of Australia trades off potentially low inflation versus still strong jobs growth. That would be quite an interesting market environment to see.
Richard Yetzinger there. Now, in our bonus deep dive interview, ANZ Head of FX Research Mahjabeen Zaman looks at the risks for the Aussie dollar ahead of today's third quarter inflation data.
I think, first of all, to start with, on the Aussie dollar, the currency has already faced quite a lot of headwinds over the recent days and weeks on a couple of fronts. Globally, risk sentiment seems to be, again, declining. Again, there's uncertainty around the US election outcome. But at the same time, we have seen US economic resilience. So we have seen a stronger dollar based on stronger economic data coming out of US, be it second-tier data or first-tier data. Everything looks pretty strong when you compare what's happening against the rest of the world and the global growth environment. US resilience is helping the US dollar and obviously hurting the Aussie because we've had geopolitical tensions on and off. That also provides haven flows into the USD, again weighing on the Aussie. And then commodities, they're not helping the currency. Demand for iron ore from China, likely to remain weak near term as inventory levels at major Chinese steel mills have been actually rising over the past couple of weeks. So again, lots of headwinds for the Aussie. Now coming to the domestic front, look, I think the upcoming CPI release will just test support for the Aussie. When you look at reaction functions of domestic data to the Aussie, we only see very short-term impact, and the global drivers tend to dominate moves in the Aussie. Now, I think all eyes will really be on the trimmed mean, which again will not fully reflect will show a clearer picture of how inflation is faring here in Australia as opposed to the headline number, which will be impacted by the electricity rebates that we've been receiving. So all eyes on the trimmed mean to give a better sense of how the RBA is going to move. Now, when you look at market expectations, market expectations for rate cuts of the RBA continue to be shifted outwards and outwards. Now, today, as I look at it, 20 basis points of easing is priced in for April 2025. So market is really pushing back. And, that higher for longer RBA really rests on the face of, the data that we are expecting this time round, where, again, trimmed mean on a year-on-year basis, we're looking at 3.5%. That still is outside the band. So points to our view for next year's hike.
Yes, and I see you've done some research on what's happened in the past when the CPI number has been below consensus, so weaker, and therefore the potential is for lower than would otherwise be the case interest rates. So what if we do have a below consensus figure, given there's quite a bit of support, if you like, for the currency because of the rate view?
Yeah, look, I think recent Aussie dollar reactions to quarterly CPI releases generally tend to imply some downside in the event of a weaker print or a weaker than consensus print, and then a relatively mild upside if there's a stronger print. Now, given that the current environment, as I've walked through, is of easing risk sentiment, commodities are also not helping. So really, I think the pressure on the Aussie will be much larger on the downside if we do get that weaker than consensus print rather than a stronger print.
Mahjabeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, October the 30th. Catch you tomorrow with all the detail from that Australian inflation data and what it could mean for the RBA. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.